navigating entity selection. Boom. What's up? Sailor.
Welcome to your weekly dose of educational, unbiased, and unapologetic business and tax talk. It's time for Nailed It, the construction and real estate finances podcast. Let's hammer out financial opportunities and pitfalls with your hosts, Jeremy Bollinger and Ian Grove.
All right, welcome back. Another more general episode before we dive into some specialty stuff next week. We're going to talk today about entity selection or navigating how to pick the right entity for your business, and maybe when you don't even need an entity. I don't know when that would be if you're some type of enterprise, but that's what we have Jeremy for. Jeremy Bollinger, Ian Grove, and entities is a technical term, but I mean, that comprises what? That comprises partnerships, corps, trusts. Where are these relevant? And if you're beyond the scale of a handyman, right? And maybe if you are a handyman and you're pulling in a couple $100,000 a year, would I need to file for an LLC, or where is that relevant and why? What are the benefits? Like, where do you want to start?
Yeah, I think right there is good. Like, entity to me, it could mean anything, right? And then the next question I have is for clients would be, how are you taxed? And everyone and their mom nowadays seems to have an LLC, and that's their response. Oh, I have an LLC. Oh, I got like 3 LLCs. Okay, that doesn't mean anything. How are you taxed? Like, I don't know. What does that mean? Okay, so LLCs are common nowadays. I'm not going to go into technical details, but it wasn't that common of a structure before. Now it's super easy to file for an LLC, but you have to determine how you want it to be taxed. And there's different types. So you can be what's called as a single member LLC, SMLLC, disregarded entity. You could choose to be taxed as a partnership. You can choose to be taxed as an N Corp. And you can choose to be taxed as a C Corp. Normally in those instances, you just do an incorporation, but you can make those elections.
Maybe to delineate even further, like, there's picking the right entity for tax purposes and picking the right entity for liability purposes. Obviously, we're not attorneys, but you can speak on that subject too, right?
Yeah. And then there's hard and fast rules of when I'm never going to have one entity type to hold a certain asset type. And we'll speak to that, especially for anyone here that is like, oh shit, just get done with the general episodes and let's start talking some real estate related things, because that's what I'm tuning into. So we'll talk about that. Single member LLC, that just means it's disregarded and you're either reporting it on Schedule C of your 1040 if you're operating business, or Schedule E if you have a rental or some royalty income. Now, depending on the state that you're in, you could have an LLC owned by a husband and wife, and then the community property states the default treatment is that you're a single member LLC, so you just report it on your 1040, Schedule C, Schedule E. Now, depending on how big your business is and how complicated you want it to be, if you're just getting started out, I would not make an election to do a 1065 or an S Corp. Again, depending on your facts and circumstances, we'll make the decision. But a lot of times you create an LLC because it creates the shield, so that asset protection for you. With that being said, if you create an LLC, but you don't create a bank account, and now all the money goes into your personal bank account, even the dumbest attorney out there will be able to say, no, you don't have a valid LLC. We can go after everything that you own. And obviously, we talk about insurance products and all kinds of other different things and various different ways to shield you from an asset protection. So a single member LLC, usually I recommend that to clients that you're not trying to get too complicated. Let's just have it on Schedule C, Schedule E. I don't have to do another tax return. Okay.
Yeah. Yep.
Next one, LLC, taxed as a partnership. 2, unrelated taxpayers. And you don't want to do an S Corp, and we'll talk about the pros and cons. And the default treatment of an LLC with 2 unrelated individuals is a partnership. Partnerships are great because you can do special allocations. What does that mean? So let's say you and I go into business together. We want to buy a rental property in Hilton Head. I'm picking Hilton Head because I had a client there once and he did pretty well. And apparently from what I see, it's very nice to have a visit. But we get this very bougie Hilton Head property out there where we're making a bunch of rental income in future years. But early on, we're like, okay, we buy it. Let's do a cost segregation study. We'll talk about cost segregation studies and techniques and risks in a future episode. But that cost segregation study shoots up a whole bunch of bonus depreciation. Well, in a partnership, assuming the transaction has substantial economic effect, we won't go into details, but all that means is there's some substance behind it. Like I'm just not making allocations willy-nilly to avoid taxes. If the partnership goes under, then you'd have partnership deficit requirement restoration. And I know I'm going way down in the weeds in case you get that occasional professional on here that calls you out on it. It's like, yes, okay, obviously we're talking generality for the mass public, but in this instance, we do cost segregation, shoots off a bunch of bonus depreciation. If I have no basis in it, like I didn't put any money in it, I don't have any recourse on the debt on there, then assigning me losses isn't going to help me. Or if this isn't a short-term rental and it's a long-term rental, I'm not a materially participating real estate professional, and you're assigning me these expenses that are going to end up on my 1040 as a passive activity loss, so it did me no good. Whereas if you put in the money, or you are already a materially participating real estate professional, or it is a short-term rental and you meet the material participation test, and also you're in the higher percent tax bracket, boom, let's shoot you all of the depreciation to save you taxes, knowing that, all right, we're going to have this restoration and it'll all work out in the end.
Or like I've got a partnership where like Chad, Chad, right? So we've got a partnership we have something called a registered investment advisory, which is that's an entity. It's not a person, and we both own it 50-50. Well, I'm not spending a whole lot of time in it right now, and he's spending a lot of time in it. We still have overhead to cover. We have an employee, but if he spends a bunch of time, effort, and energy going out and pulling in a bunch of business, like I'm not going to expect a full distribution at the end of the year for half of his effort, right? And we have a clause inside of our arrangement that allows a formula to go into place that trues up his effort versus my effort. And it doesn't have to happen every year, but it can be used for tax purposes. We have a client that you're digging into right now that he loves taking special allocation losses from his partners that don't really do a whole lot of work inside the partnerships. But it also helps with profit too. Like I can kick profit over to Chad when he's doing all the work and I'm not really doing anything for it.
Yeah, the trigger that you said right there is you have an operating agreement and you have provision in there. So to everyone out there, you're going into business with someone, do not risk potential long-term litigation because you're like, I'm just going to get a operating agreement from Facebook or from Reels or TikTok-y or Snapchat-y or whatever is going to be the social media in the future. Spend a few bucks, have an attorney look it over. It all goes back to risk mitigation. Why am I going to risk not spending $2,000, $2,500 to have a rock solid operating agreement that is bulletproof if my partner does something stupid? That's going to save me hundreds of thousands of dollars. And like, oh, Jeremy, this is stupid. That's common sense. It's not common sense.
I will always advocate. I will put my own paycheck before a professional service, whether it's a CPA or an attorney, to get the right advice, especially when you're like forming an entity, drafting a partnership agreement. You can buy them off of YouTube. I'm sorry, you can buy them off of Google or whatever, but you're going to get what you pay for. And when it gets down to a potential litigation, and partnerships are risky, like I've spent hundreds of thousands of dollars on partnership disputes, and you got to have a solid operating agreement. If you're actually in business with somebody, even if you're in business with your spouse, you should probably have it all on paper. It just makes sense. But just spend the $4,000 or $5,000, pay the attorney. Attorneys are not bad; they're good unless you don't pay the attorney, and then they're bad, and then they will take you to task.
Yeah, And I've seen operating agreements get pulled apart because they took a standard one and it talked about things unrelated to their business entity. And the attorney for the other side was like, just tore them apart. Like,
Yeah.
Stupid.
Yeah.
So that's a partnership. We'll talk about pros and cons, but I want to talk about that pros and cons while also talking about S Corps. So S Corp, LLC, you make an election. I think it's Form 2553. You send this an election to the IRS. More often than not, it's a rubber stamp. Okay, you're taxed as an S Corp. Okay, pros and cons to both. Pros, obviously, we just talked about it with the partnership. It's very flexible. You can get as creative as you want as long as there's reason behind it to do special allocations. A major downfall is all of the income that comes from the partnership could be subject to the payroll taxes. So Social Security and Medicare. Obviously, there's the caps, but all of it could be subject to it.
Like self-employment tax.
Yes. Sorry, self-employment taxes, your Medicare, your Social Security, payroll taxes. And 15, that's 15.3, 765 on each, I think is what it is. Whereas on an S Corp, you only have payroll taxes to the extent that you take a reasonable salary. Reasonable salary isn't defined. I can't tell you what a reasonable salary is. I tell my clients, look, go look on Glassdoor, look on Monster, look on Indeed, whatever. Outline your job functions, your tasks, your duties, and compare that to what you pay someone on the market. Because the IRS, they challenge that all the time. And the risk is you're paying yourself $150,000 and taking $15 million out in distributions. Like, okay, you're not paying yourself enough. And the last thing,
to that point, easy red flag. If you have an S Corp, 1120S, just double check your last tax return and look in the line that says officer's comp. And there's nothing that says officer's comp in there. You're out of compliance.
Yeah. People like, oh, but now here's what we didn't talk about in how to pick your advisor. If someone ever tells you the reason behind taking a stance, oh, I've been doing this 30 years, Jeremy, I'm going to fucking do it my way. Run for the hills. That shit scream to you. Best Buy, Kodak, AOL. They're not thinking ahead. And their decision-making and stances aren't based on Internal Revenue Code, Treasury regs, or case law. And look, again, trying to keep the time, we won't go down that rabbit hole, but just know you don't always do the same thing over and over again. If someone's explanation is, don't do it, I haven't done it, I haven't gotten audited. Technology is only getting better. Everyone now files electronically. The IRS is going to improve their systems, and they're going to send out what I think are going to be postcard audits. Just simple if-then statements or more complex scraping of data. Oh, hey, you're at 1120S, you took out $1 million in distribution, but to your point, there's no line for officers' compensation. All right, postcard audit.
Yep.
Why didn't you pay yourself?
Yep. And then you have, what do you got? You get underpayment penalties for payroll tax, and you get all kinds of love letters from the IRS. But I just want to point out too, as we're going through our first couple episodes, this is a mix between conversational logic and ranting. Which is the fun. I love it. This is fun to me. Yeah, dude, that there's some red flags that probably should be paid attention to. And that the reasonable comp thing, after I learned about, me personally, I have an S Corp I have a management company, S Corp. And after I learned about, like, it was told to me that you should move off of your Schedule C and move on to an S Corp because you won't have to pay any self-employment tax. Well, what was not explained to me is that you still got to pay now I got to get a W-2 and I got to pay payroll tax and I got to have a company administrate it for me because I'm not going to file freaking 941s on my own. So there's no free lunch. Like, you still have to pay taxes, and maybe it pencils out to be cheaper to have an S Corp just for that pure, like, as Jeremy's pointed out before, don't do something just for tax savings, because if it doesn't fit how you operate, you're probably disinheriting somebody at some point in the future. But for me, like, if I had known differently, I probably wouldn't have just picked an S corp for that reason of trying to avoid self-employment tax because I still got to pay FICA with the W-2. So I'm assuming there's other reasons to use an S corp versus just the self-employment tax angle.
S corps are usually for the management companies, for operating companies. It's just easier to administer that way. When you're taking a W-2 out of your S corp, like everyone, the advice that you're getting from social media is try and keep your W-2 as low as possible so that you don't have to pay the payroll taxes. Well, if you already have a W-2 from someplace else or you're already up above it, like take a higher W-2 because you're getting the ability to do a matching contribution. So I, as the employee, can put money aside. And then as the employer, I can do a match, but that match is often dictated by your earned income. And if you want to layer on top of it, let's say you're starting to get super successful, a cash balance plan does make sense to you. Again, I'm not saying it makes sense for everyone, but it makes sense for you as an owner. The amount that you can put on is based on two levers that are pulled by actuaries. One, you can't dictate, it's your age. So if I, as an owner, am significantly older and closer to retirement, I can put a lot more. So more money can go to me than my younger employees. And then two, the other lever is the amount of income. So I'd have to pay myself a salary of $300,000 to be able to put $3.7 million into a cash balance plan.
And so, okay, and just to clarify and drill down a little bit on like so for context, a cash balance plan is a type of what they call a qualified plan. And all they mean by qualified plan is that it's qualified under the regulatory body of ERISA. And ERISA is designed to create, amongst other things, fairness in how employers and employees help each other save for retirement, well, how employers help each other save for retirement. All that means in practical matters is that there are rules that have to be followed. And I don't specifically remember this rule, even though I actually have a couple of defined benefit plans, cash balance plans, 401ks that we help manage and administer. But can you do one with a Schedule C, or do you have to have a partnership or an S corp?
You can do one with the Schedule C. You can do a self-employment plan.
Because you have, oh, that's right. So a SEP, a self-employment plan, part of qualifying to be able to even contribute to one of these qualified plans, and that could just be a 401k. You have to have something called earned income. And if you don't have earned income, meaning you're paying FICA, you're paying some type of tax, that could be self-employment, like with a SEP, self-employment plan, or defined benefit plan, cash balance, or a 401k, you have to have earned income. If you have no earned income, you can't contribute. You won't qualify to contribute. The IRS doesn't let you, or ERISA, or whatever. So
a common question for people that are S corp shareholders: hey, do my distributions qualify as income? No, they do not. So
right.
The quick and dirty test is it had to be subject to your payroll, Social Security, Medicare, FICA.
Yeah, you got to pay FICA in order to be able to contribute. And I've had clients in the past that they have losses, they have a partnership, and they have no earned income. And they're like, I want to max out my 401k. Like, well, you can't. You don't have any income. You have to. And then we've had people that really, really want to contribute to their 401k. They don't have any earned income, but then they want to give themselves earned income. And we do the math, and you're like, dude, you're going to pay more taxes just to be able to contribute and save taxes. I'm like, let's do the simple math here. It's not rocket science, but you have to have earned income to contribute to any of those.
And again, the point that you always hear us re-emphasizing is don't just do something just to do it. Like, it should make sense, not just from a tax standpoint.
And I think getting attached to the bell and whistle side of something, like, yes, probably everything out there has some type of benefit outside of mosquitoes. I still can't figure out why mosquitoes are necessary, but something has a benefit in the financial space, but you have to weigh what you're giving up. There's no free lunch. And so you're gonna pay taxes somewhere, whether it's now or in the future. You're gonna give up control. You're gonna give up something, access. You're gonna use, everything comes with a caveat to it. So don't get too attached to the plus without weighing the minus. So okay. So to try to stay on task, S corps.
Yep.
Partnerships.
S corp partnerships, pros and cons. I think that the major con for an S corp, you never put any real estate in there. Real estate appreciates in value. You can't. There are very few instances where you can do a tax-free distribution from a liquidating distribution or reorganization from an S corp, whereas partnerships allow you to do that. So if I contribute property into a partnership or into an S corp, and then I try and take it out at a future date, I'm going to have to take it at fair value. What does that mean? Okay, so I put it in there, cost basis of 150. We did some depreciation on it and now has a cost basis of 100. And I pull it out in 10 years and it's worth 1.7 million. You're going to have to pay taxes on that delta, that 1.6. Now, there are ways to mitigate that. That's when you start getting your estate, you gift CPAs and attorneys involved. And look, I'm not going to even attempt to say that I'm any good at that. I know the basics, but that's why high net worth individuals, you want a separate CPA that also understands gift and estate taxes and trusts, and so that you don't
which trusts, grantor trust, non-grantor trust, whatever, if it has a tax ID number, or the most common type of trust, and this is not legal advice, of course, I'm not an attorney, but the most common type of trust you'll hear is a living trust or a revocable trust, which essentially just avoids probate, but that turns into an irrevocable trust, meaning it turns into its own entity after the death of the husband, wife, parent, whatever. So those are a form of entity management as well, but it's usually, to Jeremy's point, they're usually specifically used for gift and estate tax purposes and not necessarily income tax planning. And they have really inefficient income tax brackets if you're going to pay taxes through your trust, which is a totally different topic, but that's also an entity.
Yep. I think the last one we'll talk about quickly, C corporation. C corporation just means they're their own tax paying entity. So unlike the single member LLC shown on your Schedule C and your Schedule E, the taxes are paid at the 1040 level. The 1065 and 1120S, they generate a Schedule K1. All that means is it's taking all the activity that's based on your ownership percentage or in a partnership allocated to you, doing special allocations that flows through to your 1040. So K1 is just like a W-2 or a 1099 consolidated. You take that information and you plug it on your 1040. Whereas a C Corp, it's its own tax-paying entity. It is going to calculate taxable income, and then you will have to pay taxes. Oh, Jeremy, what about pass-through entity tax? Yes. So as a result of Trump's tax law change, TCJA in
Tax Cuts and Jobs Act 2016.
Yep. I think it was effective 9/17. It put a cap. It's called the SALT cap, state and local taxation, meaning if you look at your Schedule A, itemized deductions, up at the top, the first section is your medical expenses. Underneath that is taxes you pay. The biggest one is state taxes. So my state income taxes on my W-2, the real estate taxes I pay, and then personal property taxes. Well, as a result of TCJA, we all know what it now means now. There's a cap of $10,000. So that hurt the high income earners and those in the blue states, primarily New York and California. So what happened as a result? States started coming up with various different ways to mitigate that. And they came up with the pass-through entity tax. You have to make an election, and it allows the S Corp to pay the taxes on your behalf, and then you get a credit for that to show on your taxes. So it mitigates taxes. And that is a legal way to tax mitigation that the less informed tax professionals know about. Now, with that being said, you have to do it before the year is done. Most states, they won't allow you to proactively, or retroactively. You want to be proactive, but they won't retroactively allow you to make the pass-through entity tax election. I think there's one state, Emory and I are looking at it right now. I want to say it's Nebraska. Don't quote me on that.
I've seen one or two where you can do it after the fact.
Yep. But you have to do it before the hand. And with that being said, the Trump's tax law changes are supposed to sunset at the end of 25. So you potentially have 24 and 25 to do it. And if you're listening to this, we're probably not going to have a big enough following for this to affect anyone right now. You may have 1 year to do it. And I don't know if you can unwind it after the fact. So I'm just throwing that out there because the part of TCJA was Trump lowered the corporate tax rate, and a bunch of clients right afterwards, they were considering, hey, should I make an election? Should I purposely cause my S Corp to be in violation of the S rules to become a C Corp? And for most clients, it wasn't beneficial.
Well, dude, so someone recommended that to me, to one of my partnerships. Anyways, why don't we look at using a C Corp versus pass through, because then we can retain capital and only pay 21%. But then when you do the math, or at least in this particular circumstance, you do the math and okay, distributions or dividends aren't deductible.
Yep.
So that's you hear about the double taxation of a C Corp. We should probably spend like a whole episode on that. Like, when is it appropriate to have a C Corp? When is it not? But for this particular circumstance, like, because we were taking such big distributions, it didn't make any sense to just get whacked at 21% plus. You don't get the deduction for the dividend.
Yeah. For, again, high level, quick and dirty, again, facts and circumstances. Most of the time we're telling clients, look, you want to do a C Corp for a new business because the allure of a C Corp is you can do what's called Section 1202 stock sale. And don't quote me on this. I think the gain exclusion is up to 50%. You have to hold it so many years, and it has to be within a specified industry. Assets can't exceed a certain threshold. For some reason, 50 million's come to mind. But that's kind of the only time that you consider C Corps. I think again, I'm not a prognosticator. If I were any good at it, I wouldn't be here. But I think a lot of the tax changes from Trump are going to sunset starting 1/26. So 12/31/25, it'll revert back.
Yeah, and if you already had a kind of a departure from the counting population, it's going to get worse when the laws change again, because no one's going to want to do the work to A, educate, and B, if you're in the compliance world, you got to navigate your clients through.
Yeah. Again, back to, and I don't think I said this on our first one, how to pick an advisor. Your advisor should be able to educate you. And in layman's terms, if they're quoting code sections, granted, they should be able to give you a code section, say, all right, I'm doing this because of this code section, in case you want to go look at it. So you should be able to ask them and then be able to provide it. But they're like, yeah, IRC subsection 267 A, B, C, sub C, whatever says, and they quote it to you in legalese. That does me no good. Right. My wife, the doctor, when she gives me the technical jargon, all right, what does it mean in layman's terms? So, okay, if I eat this, the body processes it this way, this chemical reaction, so we want to offset it by giving you this pill or forcing you to do this.
You're like, does it give me diarrhea or not? Like, right. Am I going to be stuck on the toilet or not? Come on.
I think, in the sake of time, the only thing I want to talk about with entity selection is creating an LLC in and of itself does not create more tax deductions for you. I think that narrative is out there on social media, or I don't know where it came from, but people are like, okay, I created an LLC so that I can buy a truck or I can buy a Dodge Viper, that's my dream car, and immediately write it off. Like, no, okay, so there's some special rules around vehicles, but if you work from home all day, every day, like I do, I can't buy a vehicle and justify writing it all off. It's not a necessary business expense, necessary and ordinary, the rules by the IRS. And if they come to audit you, which they eventually will, like, no, hey, here's penalties, interest, back taxes. But if you're a real estate agent and you have one car that's solely for business, yes, let's write it off all 100%. And then for everyone else, you have to keep track, you have to keep a mileage log. So there's an app out there that I use, MileIQ. I don't get any kickbacks from this. This isn't a plug. I just like that. I just like the stock, to quote. And it quickly pops up, and I can say this was personal, this was business, and at the end of the year, it gives me a quick and dirty, the percent allocable for business and personal, and I can write off if I'm doing the mileage deduction or if I'm doing specific actual expenses. But that goes for anything. I can't just create an LLC and now I can write off 100% of my phone, 100% of my internet, 100% of my utilities. It has to be reasonable and it has to be based on reality.
Live in the now, man. Dude, I think that really just, to me, points to your favorite term and a lot of old people's favorite diaper, which is it depends. It depends on your facts and circumstances, and you've got to pick the right tool that fits the job. Like, right? You're not going to frame up a whole house with a screwdriver.
Nope.
Hopefully you got an air compressor and a nail gun. So
yeah. At bare minimum, I'm sure the contractors are listening like, fuck, dude, you better have some more heavy duty materials than just a air compressor and a nail gun.
I mean, I think it wasn't really a house. It was like a shed that we technically converted to an office, even though we permitted it for a shed. We turned it into a home office. It was detached, but I don't even think we used nail guns, man. We banged nails on that thing, and that was years ago on a shoestring. But we did it. It wasn't efficient, but if I used a screwdriver, I'd have a hell of a time. So you want the right tool for the right job, and then you want the right advisors. Back to our point, like, pay a freaking attorney. Remember, most attorneys will give you the liability test. Like, make sure that you have the right entity for the liability, but they're probably going to refer you or defer you to a CPA to make sure that you're doing it for the right tax approach, depending on the type of operation you have. So,
and the last thing I'll say, I know we're going over our time limit again.
We're just going to go over.
Right. We've only done 2. It may come off as I'm overly conservative. I've never been accused by anyone, colleagues, clients, of being overly conservative. And my sister, fellow CPA, she'll tell you I'm way too aggressive. But if there is even the slightest gray area and your fact and circumstances can allow me to argue a position, we're going to take that position. I will tell you the risks. And I may say, okay, if you're going to be audited, you may have to or be willing to fight this. And there's this cost to fight it. And you're like, oh shit, well, I don't necessarily want to do that. I don't want to save $1,000 and risk paying an attorney $30,000 to fight it all the way up to whatever area I need to. Because again, what most people, so now back to real estate and construction, everyone wants to get out of the W-2 because more often than not, you could make a higher hourly rate working for yourself. But a lot of people, when they make that change, they don't track their hours. So you went from making 150, 200, 250, 300, whatever, hopefully at a W-2. And now you're working 4,000 hours to make 100,000.
Right. That's like the allure of entrepreneurship.
Right. So have a plan, put a plan in place, make sure you're talking to the right professionals and have some understanding of what you're about to do.
Yeah. And just, as you said, talk to the right professionals, pay for the advice. In the long run, front loading the right team, the right advice, the right relationships will help you when the proverbial shit hits the fan and you got to deal with a partnership dispute, a client dispute, a liability issue, an audit. And if you want to get aggressive, just measure what's your potential exposure, and not exposure like how much tax you might have to pay or how much penalties and interest. How much time is it going to take you to fight it, defend it? If you don't win, there's always the potential, right, that you have to pay penalties and interest. But how much time is it going to take? I knew a buddy of mine in Fort Lauderdale that I think he spent 2 months on an audit, and he's a tax attorney. Like, it took up his whole life for 2 months. And I think it was all capital gain related. It wasn't even business stuff. So
yep. The thing that I always say is I can make more money. I can't make more time. Yeah, I can be a little bit healthier and not have McDonald's all day, every day. And I'm not going to be unhealthy and cut my timeline down, but I can't make more time. Like I can go out there and mine time, like that movie In Time with Justin Timberlake and that other girl. Good movie. I think it's underrated. But
I do too. I saw that once.
Yeah.
Where he runs everywhere, right?
He runs everywhere. Well, I won't ruin it for anyone, but time is how you live. You make time that way, and you could potentially live forever in this movie.
You just got to run a lot. At least to stay in shape. Well, cool. I think is, kind of rabbit hole as this was, good takeaways. Again, depends, facts, circumstances. That's kind of the theme of a lot of this stuff. And beware like of the social media posts, not trying to like rain on anyone's parade too hard. Well, kind of we are, but just there's no one size fits all. And if you got someone trying to get clicks by saying you gotta form an LLC, they're actually in jeopardy of potentially getting in trouble for unlicensed practice of law if they're making blanket recommendations and stuff like that. So like you got to be careful. And also if you're not setting up your own LLC or you're not paying an attorney to do it and someone else is doing it for you and you're paying them to do it and they're not an attorney, that's a problem too. You don't want to, and maybe even professional advisors that don't know that rule, like don't register someone else's LLC if you're not an attorney. That's UPL, unlicensed practice of law. You can get popped for that.
Those hurt. I think my closing statement is trust but verify. So if you hear what someone's saying on social media, granted, they're influencers to try and influence you to do something, but still anyone else, like even if you come to talk to me or Ian or anyone else, and they say something, okay, you can trust them, but verify. Have those probing questions. Why am I doing an LLC? Explain to me in layman's terms, like I'm a kid and I don't understand anything about anything. So I can make my own decision.
Trust but verify, dude. That's a good, I had to learn that one the hard way. Cool. All right. Well, we'll, I think that should wrap it up. We'll be back next week with some highly focused topics on real estate stuff. Peace out.
Thanks, everyone.